Welcome to this special TRADECAST, COVID-19 and its impact on trade finance. My name is Dipesh Patel, editor at Trade Finance Global.
And I'm Sean Edwards, chairman of the ITFA.
Welcome to our first ever TRADECAST.
This is an extraordinary webinar for extraordinary times, and we have four very experienced speakers talking about the impact of this pandemic on their areas of business.
So throughout this webinar, we have four speakers who will be covering different aspects of the TRADECAST. So to start off with, and from a banking perspective, we'll have Joe Wissing, who's joining us from Singapore at Lloyds Banking Group, followed by David Necker at Willis Towers Watson, who will be giving his perspective on how the trade credit insurance industry is impacted by COVID-19.
Andre Casterman, chair of the ITFA FinTech Committee and head of Casterman Consulting, will talk about FinTech. We'll round off with a presentation from Ashley McDermott, partner at Mayer Brown, on some legal issues that have arisen and are still being discussed.
So a bit of housekeeping just to start off with. This webinar is being streamed on Facebook Live and YouTube Live to ensure that as many people can participate. We will also be encouraging you to ask your questions in between each panel session. So there's a 10-minute Q&A in between each session, and you can either type your questions using the Q&A functionality on Zoom, or you can raise your hand using Zoom and we can broadcast over to you and our great panelists will answer your questions. We will also be doing a series of questions and polls to try and gauge how your business is dealing with the current COVID situation.
The results of the poll will be collated and we will be producing a report later on.
Hi everyone, so we have 281 attendees. To start off with, we have a quick poll which should be appearing on your screens now on Zoom. So the first question is who do you represent? A bank or financier, a law firm, fintech, consultancy, other, just to make sure that when we answer your questions, we know we're targeting the right audience. So we have 292 attendees dialed in and also using Zoom. And we also have 11 people on YouTube Live right now. I'll give you a couple of minutes to answer the questions. Remember to scroll down to answer the next question, or sometimes you'll need to click next. Anyone who's dialed in to this conference call can go to tradefinanceglobalcom/tradecast. Our questions and poll are also embedded as a Google form, Google survey, which ITFA and TFG will then produce a report. I'm going to give everyone a few more seconds before we show the results to everybody. Okay, I'm going to end the poll now and we will share the results. So quite interesting here, large representation from the banks and financiers, lots of others, but also law firms, fintechs, and consultancies. You can obviously scroll down to see some of the answers there. Most people are joining us from Europe, but we've got a very good representation from Asia, Middle East, and Africa. We have two people from North America. Welcome. I'm sure it's 5 a.m. very early for you guys. And 95% of our audience are working remotely from home. Highly unusual. And as we can see, most people are moderately or severely impacted, envisage being impacted by COVID-19. So now on to our first speaker, Joe Wissing. So first up, we have Joanna Wissing joining us from Singapore. Joe is Director of FI Trade Sales in Asia and also a member of the Emerging Leaders Committee for ITVA. She'll be covering from a bank perspective, supply chain disruption and the provision of working capital. Joe, over to you.
Many thanks, Deepesh, and hello everyone from Singapore. My name is Joe Wissing and I'm part of the Lloyds Bank Global Transaction Banking team over here in Asia Pac, looking particularly after trade finance. And today I want to speak to you about the impacts of COVID-19 on global supply chains from a banker's perspective. And when Deepesh asked me a little while ago whether I would be happy to do a webinar on this topic, I said to him, of course I would, because having been in Singapore now for a while, we basically saw the outbreak from very early days onwards when it was still little news back in Europe. Little did I know when I said to him, of course I will, what a complex topic it is and how difficult it is to address actually within the space of 10 minutes. So I've tried to break it down a bit for you in really what I would say is 3 key phases if you're looking at the timeline on the slide, which you should be seeing now on your screen, which really is phase 1 being the sort of like the very sort of like locally contained spread of the virus from like mid-December until early January, when news first became public really. Phase 2 is the sort of like the wider spread across Southeast Asia and the impact it's having here. And phase 3 really is the global spread that we're seeing right now with, as of today, 193 countries being affected and this really having become a pandemic. And of course, each phase sort of like cumulates into the other, but it was just an attempt to sort of like look at the different sort of like events that are happening through that lens. So looking really at the first phase, which was really just Wuhan, the city, 11 million inhabitants, plus the wider Hubei province, is actually a major manufacturing hub in China, with particularly active for the automotive industry, for example, manufacturing roofs, air conditioning for cars, heating, etc. So certainly a very important area and region in that regard. And we can almost say we didn't immediately feel the massive impact on the supply chains in the very first days when it really became public news, because that was around the Chinese New Year, and the Chinese New Year holiday got extended by a week. So really, no major impact there felt as yet, and European companies were saying they're comfortable with the sort of like inventory and the stock levels that they have from the suppliers in China. And certainly from a bank's perspective, when our financial institutions partners came back to the office after the extended holiday, they were really quick in making up the backlog. So sort of like almost BAU, but then unfortunately, although Wuhan was placed on lockdown around Chinese New Year, that measure came too late to contain the spread of the virus. So hence the holiday got extended, and a lot of the manufacturers didn't even reopen until like the 17th of February, 24th of February. And by then, certainly, manufacturers in Europe were missing their orders and were certainly having to hold production or slow down production, which has a knock-on effect also on other suppliers in Europe, because of particularly the parts chain in the automotive industry, so diverse with so many different things that ultimately make up a vehicle. There are, of course, also suppliers in Europe and North America. And these guys were basically told by their buyers, please hold production, because we have to hold production because we're waiting for these parts from China. Similarly, we saw news from Italy, from the fashion industry in particular, before, of course, Italy got hit as devastatingly as they're hit now, where actually designers were saying we have to change whole collections because we can't get a simple thing like buttons. So definitely supply chains affected there in many regards. Also in terms of exporters not being able to export anymore. So particularly in Australia, in New Zealand, a lot of farming products are being shipped to China. The demand was lagging, plus there was simply no ships actually going that way. So of course, particularly when you have as perishable goods as fresh farm products, and you can't sell your inventory, it creates an immediate cash drag. And that cash drag is certainly something that our financial institutions partners in Australia are telling us they're currently trying to meet by extending payment terms, by extending more overdrafts. But of course, it's massively hitting not just profitability, but also cash flow for a lot of these entities. And likewise, importers globally who are importing goods from China have experienced cash drags because they would have had to prepay for part of the shipment coming in. Yet the goods are not coming in, so they obviously can't convert these into finished goods that they would then on-sell. So again, there is definitely a massive drag on cash flow that we are seeing sort of like immediately in this like phase 1 going into phase 2 period. So having looked at this sort of like phase 1, phase 2, we are now certainly very firmly in what I would call stage 3, which is really the global spread, nearly 200 countries affected, and really, well, Asia pretty much having travel restrictions in place everywhere. Most parts of Europe now being in lockdown, some states in the US being in lockdown. We're really looking at of course, now a scenario where we're not just looking at who is actually able to go and manufacture and ensure the supply of goods keeps on rolling, but actually where is the demand for these goods. So now we're really seeing demand being heard, particularly, of course, the industries we've already spoken about a lot. Travel, tourism, leisure, apart from, of course, the automotive and the manufacturing sectors that we've already looked at before. So we've now really moved on from this, just looking at things through a China lens and thinking about where is China sort of like important for global demand, respectively, where is, if there is a drag in China, where is that hurting the global economy? Now we're really looking at overall global demand. And of course that will put a strain on profitability of companies, and that will put a strain on cash flows. And particularly when we're looking at a well-working supply chain, a well-working supply chain is, of course, healthy suppliers getting raw materials, producing maybe the sort of like the parts or the components or the semi-finished goods, and selling off to end buyers, who then might either manufacture the really finished good, respectively, who sell on the already finished goods. Of course, there would certainly be a sort of a cash drag throughout that chain, because if there is a lack of demand, then the end buyer won't sell. If the end buyer can't sell, they will order less, and so on and so forth, right? And then, of course, the very starting point of the chain will be able to sell less. Certainly, one of the ways to address, from an end buyer perspective, having to deal with a bit of a working capital constraint. Certainly, one possible way here is to look at supply chain financing. So, as the end buyer, I put an SCF facility in place. I'm paying my suppliers on credit terms, which possibly I could extend because they're still getting paid because they're basically obtaining the supply chain finance through a facility that's normally funded by a bank or a fund or another institutional investor. So certainly one thing we are hearing from the market a lot, and we've witnessed ourselves, is that the existing supply chain finance facilities we've got in place are being drawn quite a lot more than usual, which is not surprising because right now having the cash reserves is key, and we've seen a lot of the large multinationals even drawing on their RCFs, not so much because they need to disperse the cash on day one, but they have, of course, fixed costs and they want to have the liquidity in place. So certainly in that regard, some interesting developments there in the supply chain field. Ultimately, no one can quite yet say where this is all going and when this is all over, but assuming and hoping that the current measurements of really locking down will work, then hopefully we will see normalization kick in eventually. It's probably going to be more a matter of months now rather than weeks. But once normalization kicks in, we'll certainly will have some rethinking to do about global supply chains in a way. Is there too much of a dependence, for example, on certain markets in Asia, and therefore would it be smarter to go local? And I don't have the crystal ball to answer that question, but I think there's just a few considerations to make here when talking about taking supply chains local, which really, in order to do that, one needs to have the manufacturing capability first of all. Secondly, of course, it can be a lot more costly because a diversified supply chain, that means, okay, I'm getting some goods from Asia, but I'm also getting goods from Europe, where maybe the manufacturing is a lot more expensive. So those are considerations certainly on that end. On the other end, we do hear voices in the market that are actually saying more local supply chains would certainly help to reduce the carbon footprint of a lot of goods that are being consumed nowadays. And there is certainly an element to that as well. So definitely there will certainly, I think, be a re-looking at global supply chains, particularly by the end buyers of goods manufactured globally, to see whether actually their supply chains are sustainable in terms of actually just being able to function, because we've certainly seen that being an issue here. But at the same time, there will certainly also be some looking into whether actually this is the point in time to rethink a bit and think more local. And I think also, just as a final point, certainly from a perspective of having had to deal with other disruption that isn't just on the open account basis, but more on the letter of credit basis, which of course is very documentation heavy and still requires original physical documents to be sent from bank A to bank B. Certainly, I think this crisis again shows us that there is a great need for digitization. It's already working in many areas with a lot of people working from home, etc. But I think there is still much more work to be done in the trade finance space. And with that, back to Dipesh.
Thank you very much, Joe. So we are going to go straight into Q&A, and I'm going to broadcast over to you.
Right.
So, Joe.
Okay, where have we got the Q&A? Right.
So I'll read out the question. So it's from Udo Klein.
Okay, excellent.
Recently, Company X sent their trade finance bank the bill of lading. The banker advised his customer that due to the fact that everyone is working from home, the documents cannot be processed. So it's something we actually talked about on the phone just a few days ago. Result, cargo cannot be transferred ownership. So the question is around why aren't digital documents able to solve these problems right now? But Joe, I guess it'd be good to hear your view.
Yeah, sure. And thank you very much for that, Dipesh. And thanks very much to whoever asked the question. I probably don't want to steal too much of Andrew's thunder when he will speak later on about technology and certainly about the fintech world. I'd say there's a couple of things to that question. Documents not being able to be processed because people are working from home, of course, is sort of, I mean, in a way, that's exactly what business continuity measures at a bank are there for, to ensure that they can be processed. But of course, if really the digital channels that we're talking about today and the test cases and use cases of new tech in trade finance would really already work the way that they were envisaged to work in future, then certainly this is something that would not cause an issue at all, but that could basically be done from anywhere and probably from a simple tool like a mobile phone, actually. And that is what I keep on saying. I'm dreaming of the day when I can do my trade applications off a mobile phone. And interesting, actually, and on that note, to see that particularly the large Chinese banks are quite ahead of the curve when it comes to that. So at least one of the large Chinese players is very plugged into various domestic trade platforms where everything can be done on a digital basis. Coming back, of course, to the problem in hand here, certainly in times like what we're experiencing now, there can be issues arising like this, and they really shouldn't, and particularly, of course, not when a shipment is missed. We have certainly seen incidences in the recent, well, particularly when the first sort of like when the first wave of infections hit the market. Certainly, we have seen incidences in terms of courier services not working as reliable as usual because they simply didn't have the staff available. It had ultimately no impact on us or on our clients, because even if there was a slight backlog, it got picked up rather quickly as soon as activity was starting up again. Of course, here where a shipment is being missed, that's a major issue, and that's certainly one where I would say, on the one hand, a strong BCP plan by the financial institution will certainly help to mitigate these issues. And then on the other hand, of course, as we see technology evolving in future, hopefully issues like that won't occur anymore. But as I say, I don't want to be stealing Andre's thunder on that. I'm sure he's got some interesting stuff to say about that from a fintech perspective. We all know for sure that trade finance is more than ripe for a digital revolution. Something that I've certainly working passionately about with my colleagues constantly and with clients, and that I know many other financial institutions are doing. So hopefully also in that regard, we are much better prepared for a crisis of this magnitude if it ever has to arise again. I'd say on a positive note, though, to end on this question, we certainly are a lot more prepared nowadays. As I was saying also just before, in terms of we have at least the capability to have a lot of people working from home, etc., which wasn't necessarily the case 10 years ago. So that's a big plus, and certainly something that will only just continue evolving. And certainly this is a big push towards evolving even better in that regard. Like also this fabulous webinar today, to be fair.
Thank you, Joe. Olga Hewland has one other question which I'm going to ask you. With concerns over liquidity, have you noticed acceleration in receivables discounting, or in reverse, do you expect to see delays in honouring obligations under payables finance programs?
That's an interesting question, of course, because certainly a lot of companies need to rush for liquidity at the moment, because there is of course high fixed costs that businesses have, and yet at the moment they can't really generate any revenue. And we know that by now many sectors are affected by that, and it's probably more day by day. So certainly there's definitely a high demand for liquidity. Of course, we talk a lot to our other financial institutions partners as well, and I'd say there is an element, of course, of seeing a bigger demand for example, payables finance programs that are already in place, and companies using these a lot more that might not necessarily have used it before. But we haven't seen anything in the stage of there being delays in honoring obligations or so. So we are definitely seeing higher demand and bigger drawdowns, but no issues in terms of there being actual delays in terms of then paying back obligations. Of course, like so many other financial institutions across the various countries as well, we work very closely with our client base to see, particularly in the SME space, who is starting to have issues. We're proactively calling companies to see whether there is like cash flow problems for businesses that are very well profitable in normal times, that are just now hitting hard grounds, because this is really such an unforeseen and unprecedented event that you really cannot plan in your normal course of business for. So yeah, definitely a high demand for liquidity, but from a credit perspective, we're quite comfortable for the time being, and we're proactively speaking with the businesses where we think maybe there might be an issue as we go further down the line, and depending on how long the situation continues.
Great, thank you, Joe. So we're now going to go on to a poll specifically for this stream on the banking perspective. It's a very simple question. There are 313 attendees over here and 13 on YouTube. So hopefully you'll be able to see the question in front of you. As a corporate, are you currently looking to extend payment terms? Respectively, as a financial institution, have you experienced increased demand for supply chain finance and other working capital products? Obviously, this might not be applicable for some of the some of the people on this webinar. And just whilst everyone's voting, we had a comment to say that the quality of the slides was a little bit blurry. I think YouTube have reduced the broadcasting bandwidth temporarily, obviously for the next 30 days or so, which explains that. However, we've already, we'll have ready a full hub with all of these videos, all of the slides for people to download. You can rewatch the videos in 1080p HD and download all the slides straight afterwards. So now I'm going to end the poll and we will share the results. So perhaps we'll focus here that, you know, the majority of corporates and FIs have indeed experienced increasing demand. Joe, do you have any comments on these results?
I'm just surprised by the high number of people saying non-applicable, but that's certainly due to the many other professionals that we have on the call from, let's say, the insurance sector or from law firms or so. Yeah, as I say, I think again, it's definitely, we're seeing a high demand for liquidity at the moment. It's also the sort of like the planning for a rainy day, and now the rainy day is here, and that's exactly why I made the point before that if you of course have facilities in place, like for example a supply chain finance program, that's great because you will have it there as a tool to use when there is a time when you need it.
Thank you very much, Joe. So now we are going to go on to our next session with David Neckers. Next up, we have David Necker, Client Director at Willis Towers Watson and also a member of the Insurance Committee at ITFA. David will be covering a risk and insurance perspective, looking at the present and future impact on capacity, coverage and business models. David, over to you.
Good morning. My name is David Necker. I work for Willis Towers Watson, one of the three large global insurance brokers, in the specialist division entitled Financial Solutions. We deal with political and credit risks for banks, corporates, and traders, and we have a long experience of this class of business. However, our long experience has not ever seen anything like what we're facing today. And so it's difficult to answer some of these questions without having to confess beforehand just how awkward it is in times that are so fast-moving and unprecedented. But I'll do the best I can to give you a sense of how we see things and where these various questions that have been put to me may help us to deal with the challenges we're currently facing. So the first question is about the current state of the trade credit insurance market. I've tried to give a sense of the attitudes that the insurers are showing in these very difficult times. A structured credit insurer said, we are open for business. They made allusion to the difficulties in particular that the oil price fall is causing. A trade credit receivables insurer said that they are working hard to ensure smooth delivery of services, which is reassuring. And in particular, they provided immediate policy amendments to give clients greater flexibility to manage payment delays. So these are to be welcomed as signs of business as usual, as far as usual can be described in any terms these days, and flexibility for difficult situations. However, it is clear that all insurers are being cautious and are sending signals out to the market that current offers of cover are to be revalidated and reconsidered. Only one insurer has actually made a blanket halt on their existing offers of cover. So the general pattern of the 50 or so platforms that we deal with in this broad and specialist area is of trying very hard to be open for business and to be careful in their consideration of risk. And to some extent, I would say that insurers are also hoping to receive back from their clients useful feedback on how the client activity is changing to deal with these challenges. Turning to the question of where the biggest risks lie for both FIs and corporates, now that's a very broad question. And I think to start with, one might say, let's look at where are the biggest risk exposure areas. And in the market, they have been typically in the sectors of oil and gas, aviation, financial institutions, autos, retail, and leisure. Those are key sectors where there have been exposures for both the medium-term single risk credit underwriters and the trade credit receivables players. And in particular, certain countries have been key exposure concentrations. African oil-dependent economies, China, of course, Turkey. So inevitably, those are likely to be biggest risk areas and areas of concern for the insurers. The types of insurance exposures that they have range from short-term letter of credit receivables cover through to medium-term syndicated loans, bilateral loans, to corporates and sovereigns, and on to much longer-term exposures of project finance and asset-backed risks such as aviation. Now, in 2009, which is one of the few areas we've got to make some form of comparison, the short-term, medium-term exposures became rapidly either claims and serious problems, or serious problems that were capable of being resolved by reschedulings. There was relatively little in the way of long-term exposure at that time. In the intervening years, the insurance market has gone to much broader coverage, including long-term aviation-type risks, for example, and project finance risks. So one of the questions here is just how far the extraordinary challenges that are coming from all types of risks, both all sectors and all countries, are likely to be under pressure. How far will these complex additional layers of cover put pressures on the insurers to deal with their much more complex set of challenges than they've had before? So I think it may well, the biggest risk may well lie in the operational pressures, where the front-end underwriting resources are going to be stretched because they will be required to work on workouts and claims. One should bear in mind it won't necessarily be the obvious risk issues that will be a concern, but it will be in getting to grips with the insurers having to manage a wide selection of complicated problems. Now, turning to the third slide, third question, is there enough capacity in the market to support the demand? That is a very difficult question at this stage because we simply don't know how demand is going to evolve. But typically, capacity in the market is something which tends to be a topic of conversation and concern because it tends to aggregate and concentrate in what one might describe as the usual suspects, difficult areas where many insurers find that they are being solicited for cover, such as African oil exporting countries, Nigeria and Angola, or Turkey, for example. So that capacity has always been subject to the question, well, subject to the observation, there's not enough capacity for this. But one must bear in mind that insurers have careful management procedures for their portfolios, and therefore they must also take into account the reinsurances that are available. So to date, the capacity has been good for the demand, but up till now, we have not faced the kind of global, all sector, all country potential problems. And therefore, all one can look to is to say, well, let's step back and see how the market is evolving. And my most positive comment here in terms of hope for adequate capacity for the future is that the regular market survey, which WTW carry out every quarter, admittedly the most recent one is just prior to the COVID-19 virus explosion, showed the capacity for 2020 had grown despite the fact that under much tighter insurance and reinsurance conditions at the latter part of 2019, which led to some participants pulling out of the market, there were some new entrants, and there was a slightly increased capacity. We're talking about figures which are significant. On any one risk, 3.2 billion notional capacity for non-honouring of sovereign, what we call contract frustration risks, 2.4 billion for credit private obligors, and 3.1 for general political risks. Now, those are the aggregate theoretical maximums added up, which is the standard method the market uses to track its aggregate potential capacity. So a slight increase. On that basis, despite awkward and difficult conditions at the end of 2019, with stress in many areas, economic stress and political, the market was still showing a good increase of capacity. And I think that's the most comforting thing we can say in answer to, will there be enough capacity to support the demand? Turning to the fourth question on the next slide, what should users be doing to manage their ongoing demands? This is a critical moment for people who have been active in this credit risk mitigation area, because for pending transactions, insurers are going to need to work very closely with their brokers and with insurers to revalidate cover and ensure that transactions which are already maybe quite close to being consummated can go ahead. But they will be subject to review and amendment, and it must be clear to anyone who's been in this business for a while that there are some risks which are perhaps under pressure and maybe were already difficult to find capacity for, which will need to be very carefully handled in order to make sure that the underwriters go ahead and actually provide cover. That may prove problematic. But for existing business that's already on the books, users need to give regular updates to their insurers, and especially where, if those risks get into difficulty, they need to discuss with their brokers how best to get the information across to insurers in a consistent, measured, and effective way, bearing in mind the claims provisions of the policies. This, as I've said, is a critical area. One could say that this principle of communication to, apologies to Tony Blair, is absolutely essential. The most successful users of insurance, as I'm sure that those who are banks and traders and corporates out there will recognize, are, when they deal with clients, are those banks and corporates who have a good working relationship with their insurers and treat them as risk partners. This is an area where brokers have a key role to play in making sure that traffic is managed in a sensible and efficient way. Messages that, in this particularly potentially febrile environment, need to be carefully considered and explained cautiously to insurers, who in turn are making cautious risk judgments. I think that one has to bear in mind, in particular, on a practical note, that for a bank or a trader or a corporation to be able to communicate effectively across what is now 50-something insurance platforms in a remote and virtual community is a challenge, and it's one that brokers it's their responsibility and it's their job to rise to that occasion and provide good communication in two ways, obviously, not just about the additional risks that the risk climate, but also about the financial and the operational response that insurers that clients would expect of their insurers to check their solvency and their ability to respond rapidly. So communication and observation is critical here. Finally, what changes might happen in the market? Will insurers' appetite change? This is an impossible question, really, to answer with things moving as fast as they are. But let's remind ourselves that they have taken, to date, a strong open for business approach, confirming their underlying commitment and appetite for this class. Any changes that in their appetite will depend upon how key sectors respond and whether they survive effectively. I mean, there are big questions around some of the hydrocarbon projects, some of which may have been already under stress some time ago. So insurers' appetites here are going to be clearly crimped by the difficult situations that some of those projects will be in. However, you must also bear in mind that these sectors were already subject in some areas to revised appetite because of the adverse trends with energy pressures, climate change pressures with rejection of coal and shift to renewables, and the excessive leverage of some of these entities. However, what we can go on, that's the only thing we've got in a sense to look at the way that the market responds under stress. We can go on the way that it responded in 2009 when it faced its major test as a fledgling market and was able to respond with $2.5 billion of claims, dealing with, at that stage, an extraordinary range of problems that they had not encountered before in very many countries and in many sectors. And they emerged from that with undiminished appetite and, in fact, undiminished solvency and financial security. Clearly, once this crisis is over, business will go on, and it will require a sensible and responsible approach for clients to recognize that insurers' appetite is conditioned as well on the way that those clients who respond responsibly and carefully communicate well, they will get better treatment from insurers subsequently. That was definitely the outcome of 2009. It's a factor which still persists. Reputations are made and broken in critical times. That's all I have to say at this stage, and I look forward to your questions.
Thank you very much, David. So now we're going to go on to the questions. So we're going to start with a question from Mohammed El Naga. What will be the role, I think it's ECAs he's talking about here, what will be the role of ECAs to protect exporters and their financial providers in this pandemic crisis? So David, I'm just going to get you on. Over to you.
Right. Well, thank you for all the questions. So thank you, Mr. El Naga, for this particular one. This is a very topical question, which I'll be brief with. And this is related to the fact, and as in 2009, people looked to have support from their export credit agencies. And I think it's an excellent reaction. The difficulties, however, will be about how to translate this and how to find proper delivery mechanisms. And in some countries where there are existing export credit agencies that are well attuned to delivering solutions directly, that helps, like in Denmark. In other countries, like the UK, where export credit relationships are done with private sector insurers and the state is not involved, it's harder. So all one would say is that this is, I know there's a question which the European Commission have just launched, which is due for response today, asking for views on this. And recall from 2009, it was something that was a very hot issue, and each country has had previous experience of how to resolve that. Okay.
Thank you, David. So another question from Anurag. A number of insurance policies have the force majeure clause whereby the underwriter will not need to pay. Does the COVID-19 pandemic fall under this clause, thereby making it difficult to claim under insurance policies?
That is a very difficult question to answer without actually seeing what the policy says and what the underlying contract says. It's a vexed issue, and I know that Ash may well want to make some comment on from a legal perspective. But like many other questions that you come across in insurance, you have to rely on having a properly drafted contract, which provides the right, a properly drafted insurance contract, which sits on top of a clear loan agreement or contract. And that is all one can say. There's too many variables to be able to give an answer that would be anything other than misleading.
Thanks, David. A question from Celia. David, in how far could it help that multi-line insurers are diversified, i.e. less vulnerable to a credit crisis? Do you think that there are other risk classes such as life or property or casualty less concerned by COVID-19? And so insurers, will they be better to go through this crisis, or do you think that the virus has also a large impact in these other insurance business areas?
Celia, thank you for the question. I think, first of all, one must stress that the insurance business, which is a huge global business, is divided into two components, to life and non-life business. The life business is separate and is run more like an investment management business. So it's got the right kind of approach to keep funds aside. It will, of course, be affected by the massive decreases in, or increases now, but decreases in stock market prices, which affect the pension liabilities, but it's not the area that we deal with all the time, and is and has always been, I think, well regulated. The non-life business is equally huge and wide, and all one can say here is that that's the sector where the financial risk business is, and it's a small part of it. But nonetheless, this is a business that can put up 10, 20, 30 billion dollars of claims for natural hazards. And it's geared up to that. It's geared up to sharing the risk through co-insurance and reinsurance. And to date, it has had an excellent track record of responding to large-scale natural catastrophes. And as I mentioned in my talk, in the financial sector, it has had an excellent record in dealing with the 2009. The diversification of these general property casualty insurers is generally seen by banks in particular as a positive, and certainly by regulators who take this into account, because it's a rational approach that when you look at actuarial exposures, you would expect there to be a non-correlated benefit from different classes. So I think your question is essentially that the size of the capital base and the past performance of these insurers leaves one in really comfortable that they're dealing with the right sort of people. There are questions raised at the moment about reinsurers, but these again, I think, will be seen to be well-capitalized businesses that have been through problems in the past and are established with long track records.
Thanks very much, David. Ian Gunn from PIB, it's more a comment. We've already had confirmation from one insurer that they do not regard COVID-19 as a natural disaster or force majeure event, but have covenanted that contractual terms will need to be considered in the context of any claim. We've also had Pradeep saying, I understand that the insurer's appetite will change, leading to adverse change in risk premium paid by exporters. He'd also like to understand how it impacts the trade finance companies, factors, etc. But I'm going to get you to take that one offline, and we'll do that in a written Q&A after, just in the interest of time. Because what I want to do now is do a quick poll to the audience. There are 299 of you currently on this webinar, so I will launch this poll. It's a couple of questions. So first of all, what use do you make of trade credit insurance? None, private market only, private marketing, ECAs only, other or not applicable at the end. And then just on to the next question. What are your immediate concerns with regard to trade credit insurance? Is it clarity from insurers on positions on cover availability and appetite, responsiveness to requests for payment extensions on existing exposures, potential withdrawals of future cover, the ability to seek alternative insurance options, responsiveness and clarity on claims procedures, or ensuring full compliance with the terms and conditions of the policy and eliminate any risk of invalidating it? So whilst we wait there, if anybody is dialed into this call or watching us on YouTube, please go to tradefinanceglobal.com/tradecast. You'll be able to answer all of these questions via our Google form, but the more data we can collect on this, the better, because ITFA and TFG will be producing a report afterwards. Okay, so I'm going to end the poll now and show the results. So David, over to you. And I guess on question one, the majority of people look at making use of trade credit insurance through private market and ECAs, not just one exclusively. And it appears as though the immediate concerns are around clarity from insurers on positions, on cover availability and appetite, and also potential withdrawals on future cover. Do you have any comments or thoughts on this?
Yes, I think it's reassuring that we're dealing with a community that largely is using a wide range of both sectors, both private and public sector, which is generally our experience in our client base. I think that I'm not surprised about the clarity, response with clarity and potential withdrawals of future cover, because in my view, I hesitated when answering my own questions as to which one was more important. I think that those two are the key issues. The messages, one person has asked a question about communicating and responsible behavior from insureds, from clients. What about insurers' responsible behavior? And I would just say in passing to that absolutely, we look to how our insurers are going to behave, and we expect them. And to date, they have been, especially the trade credit insurers like Tradius, who were quick to issue commentary and reassurance on flexibility. Euler Hermes, who've been providing seminars, and obviously COFAS as well. These three insurers are, I think, mindful of the fact that their behavior in 2009 was seen as a knee-jerk reaction to cancel cover, and they're at pains to show their reputation as taking things carefully. But there will be difficult moments because they have massive exposures across all sectors. And anyway, all I would say is yes, clarity is definitely something you expect. And a final brief plug that you do need to if you've got a broker, you need to make them work hard. This is the time. Okay.
Thank you very much, David. So now we're going to go on to our next session.
Now for FinTech, to Andre Kasterman, head of the ITFA FinTech Committee and of Kasterman Consulting. We see potentially a lot of change happening in FinTech.
Thank you, Sean, and welcome to all of you this morning. If you're based in Europe, good afternoon, good evening. If you're based in Middle East or Asia, and we are delighted to be running this webinar on the ITFA side together with Trade Finance Global. We want to address here in this section the technology-related topics and the consequences of the coronavirus from a technology point of view. As you can see on this slide, I'm an independent consultant working with a series of fintechs, including Intix on data management and TradeTech on trade distribution technology. First, let's look at the unexpected impacts on people and businesses that COVID-19 had since a couple of months, and more importantly over the last 2 weeks. Cross-border trade is definitely impacted, as on the social, logistics and transport aspects we need to indeed avoid meeting people, avoid physical contacts, not only with people but also with some material, and postal services are being disrupted because flights are disrupted themselves. So the economy is at risk. Businesses are in particular vulnerable position, and as the economies are stalled, basically. So government are announcing more and more ways to extend financial support through loans and guarantees. We'll come back on that. An example on this slide of the dangers of this virus, living for hours, as the title says, in air particles and days on surfaces. I think we'll know more about this over the coming weeks as research is ongoing. Similarly, on this particular example here on the transport side, the flight suspensions are definitely slowing down delivery to China, which has severe consequences for us working on documentary trade and depending on the delivery of physical paper documents as part of financing and risk-related transactions. So this whole situation is creating a series of challenges, no doubt, risks for sure, and as well as new options that we need to carefully consider on the trade side. So specifically for the trade community, in terms of people, logistics and trade related aspects, the work from home is now becoming the norm. The electronic signatures and documents seems to suddenly being preferred compared to wet inking documents and hoping those documents reach the right signatory. Definitely the government support is being offered with new issues for originators who want to pass on this government support to SMEs, but could face in this process balance sheet constraints. So we are looking at new digital options that are actually available since years, potentially since already adopted by multiple organizations, but I think a lack of adoption is still the issue here. So we don't need new technology, we need the available technology to be implemented in order to support those, in order to address those issues. Here is an example of Germany raising debt as part of a 350 billion emergency package. This includes unfunded as well as funded participation of supranational organizations, governmental organizations into the economy, and we'll come back on that in a few seconds. So from the ITFA side, definitely I'm not here to tell we need to invent more technology. We have no time for that. I think the technology we have through various fintechs, we have on the ITFA side 23 fintechs now registered to ITFA, and as you know, there are many more in the market. But if we concentrate on the 23 we have in the market, the key challenge in the very short term, in the next few days, weeks, is to increase our openness to those available digital options. Often the adoption of those seems to be slowed down by a lack of priorities within banks. Now we have all the reasons to indeed implement some of those technologies, such as indeed data management technology, to enable secure remote access to internal systems, whilst at the same time protecting those internal systems from remote attacks. So having a double data layer is what data management technology can help financial institutions implement. On the Intix side, for sure, this is working well for the current clients, and we hear it from them as they are adding a number of users onto that available technology. So technology can help to ensure people working remotely continue to operate as if they were connected to their internal network whilst they're working from home. Similarly, we know within ITFA we have digital document checking technology vendors such as TradeStream and a few others, and they are critical in the trade back office to ensure document checking continues to be operated in a fully digital way. That means no need to get hold of the paper document. People can check documents as those documents have been scanned, understood by the technology, and pre-validated by those technologies. And indeed, for those institutions that have already adopted such technology like TradeStream, this is definitely making a big difference when people are working from home and being able to perform their job wherever they are, as if they were handling paper documents. On the logistics side, definitely we hear from people that wet inking, as I said, is not possible anymore, as documents are not reaching the right people. Not getting access to those paper documents is an issue when you need to put your own signature, whilst if you're using electronic signatures, for instance, as part of the European eIDAS, or whether you're using electronic payment undertakings, as ITFA is rolling out through the Digital Negotiable Instrument Initiative, those solutions, available technologies, are making things much more digital, sometimes fully digital, and enabling you to run your business as an originator and extending funding to your corporate clients, including SMEs, on a fully digital basis. So very important also to signal those technologies are available. It's a matter of adoption. We need to increase our openness to those options. And finally, on the funding side, definitely the trade banks want to now allocate those the government support, the public funds, and via loans, but also those public funds can be allocated to SMEs and mid-caps via trade receivables or payables. This is another option that we need to highly consider. Technology makes now this happen through the TFD initiative and the TradeTech platform. So meaning that government funding, rather than extending that only through loans, can also be allocated to your corporate clients on a much more targeted basis, with full traceability of the impact and the use of those funds through receivables and payables. This is definitely operationally far more challenging if you do that on a manual basis, but technology makes a difference again. Some corporates will also want to work with alternative financiers, with non-bank funders, with asset managers that are entering the market since a couple of years. So these are also available options if they can't work with their traditional payment banks or cash management banks. And those are also accessible, I would say, via online receivables platforms. I can name a few like Liquidex, Trustbills, Levanter, Finon Exchange, Demica, and many more that you would consider within your country. So finally, on the ITVA side, we have 23 fintechs indeed since since we launched the fintech committee. Here they are. You see all their logos. They address very specific pain points, as some of the ones I mentioned in the previous slide. They can do much more, which we can certainly discuss over time. But on the ITVA side, we're definitely committed through the Digital Negotiable Instrument Initiative and the Trade Finance Distribution Initiative to make sure that those very short pain points are can be addressed through those technologies, and I will be happy to take your questions in the next few minutes. Thanks again, Deepesh, for organizing this, and for Sean for inviting me. And let's move on to the questions. Thank you. Over to you.
Thank you very much, Andre. So we're going to move straight into the questions, and actually we'll go to Udo Klein's question from earlier on. I'm just going to get you up on the screen, Andre. So referring back to the bill of lading and the fact that the cargo couldn't be transferred ownership because the documents couldn't be processed. Andre, how come after more than 2 years, various technology related to trade finance solutions are still not able to handle digital documents and document flow, especially when many of the world's largest trade finance banks are part of the consortia and networks that we see?
Yeah, it's a key question indeed for those types of documents. The bill of exchange, for instance, we have technology platforms that enable to digitize bills of lading or other types of instruments. And those platforms are being used by some corporates, by banks, but the adoption is definitely still low compared to the need in the market. So I think the approach that banks have taken is a very much a commercial approach. Where is the business case? Where is the client demand? And basically that's a bit of the story of my life over the last 20 years on payments and trade, is to promote digital options. But the appetite from banks is quite limited to responding to clear client requests and looking at it from a financial business case. And here we have a new use case, a new reason to invest in those technologies from a business continuity planning perspective. So it's a new dimension, a new priority that this COVID-19 situation is introducing, a new reason to invest in those technologies. And I think it's the same for the work from home policy, which was resisted by many employers. And those employers are very happy now that this is technology possible to continue getting your employees work from home, whereas in the past you would try to resist it. So that's one thing, is openness because of a new situation will increase. Hopefully that will trigger more adoption, but I don't think it will be that natural. We need also policymakers to jump into this and to enforce, to also realize they have a key role to play in terms of adapting some of the laws, some of the legal practices, because there are stumbling blocks, there are obstacles on that side, and the action here is in the hands of the policymakers. So it's not just about the commercial appetite on the bank side, but definitely also the openness of the political world, the policymakers to central banks. We saw a question on Algeria, for instance, that have authorized to work with scanned documents. That was one of the questions I saw earlier during the webinar. This is a good attitude of the policymaker to relax some rules, to adapt some rules in order to make digitization achievable.
Thank you very much, Andre, and also, an extended thank you once again to ITVA and ITVA's committee for making this webinar possible. Andre, I'm afraid we're out of time for questions, and we're going to quickly go on to the poll, but just for our attendees who are listening in, we've also uploaded the ITVA FinTech deck, which talks through some of the initiatives that are going on at the moment in terms of digital instruments, documentation, etc. I know someone anonymously asked what the current initiatives are to formalize some of these areas of digitizing trade finance. So now onto the poll, which I'm going to open up.
Yep.
So the question is, what solutions, if any, are you looking for to improve your efficiency? E-signatures, digital documents and contracts, workflow automation, virtual meetings and calls, secondary trade finance and distribution automation, and insurance digitization. Okay, so there you go. Digital documents and contracts. Andrew, do you have any comments on the solutions here? It looks like there's a whole variety, and everyone's looking at a whole variety of digital solutions here.
So I think the technology again is available and it's being used. The technology related to digital documents, digital signatures is available. It's a matter of expanding that to our trade instruments, trade documents, such as the bill of lading or such as the bill of exchange, the promissory note. On the ITFA side, we do have a specific focus on the use of digital documents and digital signatures backed by a DLT infrastructure for traceability that is specifically targeting the digital negotiable instruments. And we're working with Enigotime as the backend document technology provider for this. And we're going to release in April our legal white paper developed in partnership with Sullivan on this particular issue. Of course, it's only one step in the right direction, hopefully. There are more steps that we will be looking at, and those steps are often actions that are required on the policy side to change the laws, to adapt the laws to the new technologies that are being available. I'm referring here to the Bill of Exchange Act that should be amended to ease the rollout of technology in support of negotiable instruments.
Thank you very much, Andrew. So now we're going to go on to our final speaker, Ash.
And finally, Ashley McDermott, partner at Mayer Brown, to talk about the legal issues. Ashley, over to you.
Thank you, Sean. Thank you, Deepesh. So as the guys say, my name's Ash McDermott. I'm a partner at Mayer Brown. Mayer Brown's an international law firm, for those of you that are not aware. I would encourage you to take a look at our COVID-19 portal, the address of which is on the front cover of the slides in front of you. I primarily cover loan transactions, including structured trade finance, and some receivables work. And I'm going to talk today through some of the aspects that we're seeing in relation to the current climate and the questions from clients, some contractual remedies that you may be able to look at, and also some possible changes that we expect to last beyond the current period of uncertainty. So moving quickly on, in these highly unusual times, the earlier speakers have spoken about some of the things that they're seeing in the market. From our perspective, we're getting a lot of questions about possible covenant breaches, amendments to documentation that's required, questions around insurance policies, and also questions about the impact and extent of new laws that are being passed almost on a daily basis, ranging from stay-at-home orders in most jurisdictions, lockdowns, to moratoriums in some jurisdictions on repayment of debt. So a broad range of things. As I say, this session is quite a whistle-stop tour, but hopefully it will be useful for you in looking at a few of the things that we're being asked. So moving beyond the overview slide, I spoke about what we're going to say today, so we'll move straight on in the interest of time to the most pressing issues slide. And you'll see that in this slide, I divided the sections into three. We're getting practical questions, we're getting legal questions, and we're also getting a few questions on insurance. So taking each of those points in turn, on the practical side, obviously the current climate has a huge human impact. And so clients of ours and yours, I'm sure, are trying to still perform as much as they can their obligations to their counterparties and their clients, but also protect their staff and comply with the rules. And that's been a moving target and a constant battle, keeping up with the rules, but also putting in place things that are going to work and allow businesses to perform. IT, well, as many of you will know, many banks and other institutions, law firms, etc., now have very strict policies when it comes to confidentiality and security of IT. We're seeing that is butting up against the need to have flexibility in order to allow transactions and business to continue when everybody's working from home and unable to access printers and scanners and that sort of thing. It's quite a detailed topic, but suffice to say, we aren't seeing many institutions give much flexibility to their employees or their professional service providers when it comes to that, on the basis that the information confidentiality and security requirements cannot be waived or amended much, even in light of the current situation. So we're getting quite a lot of questions on that. We're seeing registry offices being closed, so things like Companies House and other registries around the world. Notaries are finding it very difficult, if not impossible, to turn up to meetings to notarize documentation, which has had an impact on signings and closings and will continue to do so. And lastly, presenting. We've seen banks finding it very difficult to present documents in the trade finance context, and that has caused delays. We saw that in Asia, and we're seeing it now coming into Europe and the US a little bit. So moving on to the second section, what are the legal questions we're looking at? Well, a lot of those so far have revolved around signings. So what can people do in terms of signing documents electronically? This is one of the areas where I expect the changes that we've seen, even in the last 2 weeks, to continue beyond the current period of economic and social uncertainty. We've seen a very fast adoption by almost all of the law firms, at least in the London market, to using electronic signings. And a large part of that goes back to a QC's opinion that the London legal market obtained from Mark Hapgood QC in 2014, but it wasn't hugely adopted because people could still use wet ink originals, wet ink signatures, because they always had done. So that is a positive development, and I expect that to continue, and people being more flexible around using electronic signatures and platforms such as DocuSign. A note of caution on that, of course, is we all work in cross-border transactions. It's the very nature of trade, and it is challenging in some jurisdictions to rely on that. So you always need to check with the lawyers in the jurisdictions of your counterparties. It can also be difficult to register documents sometimes if you're using anything other than a wet ink original, for example, in the UK at the Land Registry. And lastly, we've been looking into the question of whether negotiable instruments such as bills of exchange can be signed electronically and emailed rather than in paper form, wet ink original, and kept in bank vaults, etc. Particularly interesting perhaps to many on this TRADECAST. Just finally, I'll talk about insurance briefly. David touched on it or talked about it a lot earlier. We are getting questions where clients, banks, counterparties are very closely looking at the wording in their insurance policies, the exclusions, the non-payment insurance policies, exactly what is covered and what is not, and we expect that to continue. So moving on to the next slide, how do you assess your existing contracts? Well, this is something which lawyers will be doing every day of their careers, but it's important, I think, to just go over a few of the key concepts here, just to make sure that you're aware of the best practice in this respect, in respect of your own contracts. So firstly, we recommend identify what contracts you need to look at and indeed which are of the highest priority. So that may be because they're a very important counterpart, a supplier of yours. It may be because they're of high value. It may be both. And then once you've identified those, what are your options? So we get a lot of people asking questions and printing client briefings around force majeure, frustration, legal concepts such as this. My advice to you and to your clients will be take a look at the agreement itself first before you jump to those parts, because it may be that we've seen examples where actually there was flexibility in agreements in terms of delaying payment periods or being flexible in terms of the obligations of suppliers, etc., in distress scenarios. If those don't exist, of course, you can look at concepts such as force majeure and frustration, and we'll come to those a little later. Something which is often overlooked is a notice requirement. So often many contracts of different types will have an obligation on one party to the contract to notify others if certain events arise. And that's particularly important when it comes to things like trade insurance and notifying your banks of any sign of distress. Often that's a very advisable thing to do. It can start the claim periods, counting, etc. So don't forget about those. Another thing is what messaging and communications do you want to put out to your counterparties? We expect a lot of the current distress to be resolved either amicably or at least outside of a court process. Most of the contracts that we're all party to never envisaged a period like we're going through now. So we expect, as a commercial practical matter, parties to try to be flexible as much as possible. So think about the messaging and the style that you want in terms of formal communications with your counterparties. You need to strike that balance between being flexible and helpful and trying to maintain relationships, whilst also not meaning that you have basically waived your rights later on if things do turn out to be not amicable and you end up in a dispute. Watch out for jurisdictions that have concepts such as mitigation of loss. So many jurisdictions require people to mitigate their loss. The extent to which that's possible in this current environment is another question, but that's something worthy of note. And finally, do talk to your lawyers wherever possible. This is not an easy area. Each contract is different. Each law governing contracts have different approaches to things. So I would recommend you reach out to lawyers internally and externally to the extent possible. So moving on just to the next slide, how do you amicably resolve a dispute or make amendments to your contracts? Again, a wide-ranging area, but the one thing I would say to take away from this is that be clear. The extent to which you're amending your existing contractual terms, agreeing to a different regime, perhaps you're agreeing to extend payment terms, as I said earlier, or something similar. Is that a temporary arrangement or is it permanent? If it's temporary, how long should it last? Only during the period of a lockdown? Further, you need to be clear in the documentation you sign setting about the revised arrangements, what you're agreeing, and whether you're agreeing to walk away, I would say shake hands, but not shake hands, walk away, or whether it's just a temporary arrangement and you're trying to mitigate loss in the short term. And finally, do you need to discuss any such amendments or resolutions to a dispute with third parties such as banks and insurers, as I mentioned earlier? Moving quickly on to the legal concepts, force majeure, frustration, and others. I've set about a bit of detail on the slides here. I don't propose to go through it all. There's a lot of case law in English law alone, and each jurisdiction has different views of these concepts. I'll give a short summary in relation to frustration and force majeure because I think they will helpfully set the scene as to how easy it is to rely on them. So force majeure allows a party affected by an event beyond its control to suspend its obligations under that contract. Deals such as project finance transactions have very heavily negotiated force majeure provisions, very detailed. Many contracts don't. They may refer to force majeure alone. They may list certain events. Not many have actually listed pandemics and things of that nature. So it may not be easy to rely on that concept legally. We've seen very recently people like Primark have told suppliers that they're stopping all orders and not paying for existing orders on the basis of force majeure. I expect those types of transactions may end up going to court, and we'll watch this space. Frustration is where there's an impossibility to perform a contract, to perform your obligations under the contract, so the contract should be set aside. So even more difficult to prove in many cases. I think it will be especially difficult for companies in a supply chain to rely on concepts such as this, because on the one hand, particularly long supply chains, on the one hand, you'll be looking at your own suppliers, asking them to perform. It makes it then difficult potentially to turn to your customers and to claim force majeure or frustration. We have lots more notes and information on our website, as I say, including a COVID-19 portal. So I would encourage you to look at that to see what more is out there. But in terms of changes for the future, I think that people will be more used to electronic signings and working remotely, and hopefully there'll be some, that will continue, and there'll be some other developments as we work through this period together. Thank you very much, and I hand back to Deepesh for questions.
Thanks very much, Ash. So, Ash, just going back to David's session from earlier on, and I'm just going to get you up on the screen now to our audience. A question about avoiding claims. Can insurers typically avoid claims under non-payment trade credit policies?
Yeah, thanks, Deepesh. I mean, we've had a lot of questions along similar lines, exactly as you described. So I just wanted to touch upon a couple of things there. In typical non-payment trade credit insurance, insurers should be somewhat agnostic in terms of the reason for the non-payment. It's quite a different product, as David touched on earlier, from things like political risk insurance. That said, there are exclusions, and so you need to carefully look at your contracts as to exactly what the exclusions are. And what complicates this and makes it difficult to give a general answer is that different insurance policies are governed by different laws, and concepts like force majeure have different meanings under different laws. So it is difficult to give a general answer. However, we advise a lot of banks on these types of insurance policies, and we have received quite a lot of questions on this in the last week or so. And typically, we're not seeing provisions, exclusions, which would allow insurers to refuse to pay out on the basis of the current circumstances on the whole. There don't tend to be specific pandemic exclusions, and where there is force majeure wording, we think that it will be difficult for them to rely on. Our insurance team is shortly publishing a briefing on this, which will be uploaded to our portal, the details of which are on the slides. And I think, having spoken to a few insurers recently on the very question, the extent to which, even if insurers could point towards a force majeure exclusion, the insurers we've spoken to, some of the major players in this space, view it somewhat as an existential question, and David touched on this as well. They need the product to work in times of distress, otherwise clearly in the future people won't be buying it. So we hope that everything works out such that insurers will not seek to avoid claims on this basis. But as I say, it's very much a fact-specific scenario, and you do need to assess your exact policy wording with lawyers from the jurisdiction governing your policies.
Thank you very much, Ash. Just to our attendees, and we're going to carry this webinar on for the next 25 minutes or so until 11 a.m. UK time, just to answer quite a few of the questions, because there have been an awful lot of questions in the chat. So we're going to be expanding this out to all of our panelists. So if you can continue sending questions through, and Sean and I will be asking those to the rest of the panel over the next 25 minutes. But Ash, one more question for you from Thomas Laporte-Manny. Are lawyers recommending to now adopt new COVID type clauses in any contract? And if so, how are they approaching this?
Yeah, thank you. It's a good question. I think it depends on the documents and the products and the areas concerned. We've seen from a general lending perspective, a lot of big companies looking at, in terms of when this crisis first started happening, and particularly as it came through Asia, multinationals were talking about adapting things like material adverse change clauses, maybe making some changes to their financial covenants, etc. And we have seen, as I say, a renewed focus on these types of exclusions in insurance policies in the trade credit and receivables purchase space. I must say, at the moment, there aren't a great deal of new transactions starting up, and so that won't be a surprise to many people on the TRADECAST. So I expect actually there will be certainly a lot more focus on pandemics and given what a huge impact it's had on the entire globe. And so, I think that's something which will continue to play out, and we're just seeing the early stages of that at the moment. I mean, I think one thing we are seeing is, banks have already, some insurers, as David mentioned earlier, have already said that they will extend payment terms for differing periods almost automatically, although usually there is some caveat to that to say, for typically well-performing or generally well-performing companies, so those companies and counterparties that have performed well up until now, query exactly what that means. I guess the devil's in the detail there, and we'll see how that plays out. But at least, that's a specific change, hopefully, which will help things over the next month or two.
Thanks very much, Ash. We're now going to open up the final poll to our listeners. Apologies. It's a very simple yes/no answer. Do you think there is sufficient legal certainty about the use of e-signatures? It's one of the topics that we've seen asked quite a lot over the last few days. Okay, I'm going to share the results now. So actually quite a lot of people say no, and Ash, obviously I know you spoke about this in your presentation earlier, but do you have any further comments?
Yeah, I mean, I think, like I said, I think in the space of a very short time, the world has got a lot more up the curve in this respect than previously, even though the laws in most jurisdictions have yet to change or improve. And Andre talked earlier about potential changes to things like the Bills of Exchange Act. So we expect there will be future legislative changes to make things clearer, but clearly governments are focusing on other things right now. I think the base position is that, at least under English law, e-signatures should work typically. There are some doubts around negotiable instruments, as we've talked about before, and also difficulties sometimes with registrations and things like that. But generally speaking, e-signatures should work fine, whether you're using platforms like DocuSign, or whether even you're affixing a signature yourself via PDF, or even typing in a signature and emailing saying that typing in of your name constitutes your signature. Under English law, that's typically fine. The challenge for trade in particular is that, clearly, as I said in my video, it's a global business, and there are different rules in different jurisdictions. I saw one of the questions or the comments from one of the participants talked about in France, assigning purchasing receivables in France. The rules in France are slightly more difficult than in the UK, for example. So, it definitely requires an analysis across the different jurisdictions. And I think it was interesting to see the responses were quite even there. I expected actually more people to say there was more uncertainty. So it's encouraging, and maybe that reflects the fact that even in the last 2 weeks, people have been speaking to their lawyers in-house and externally and getting more comfortable with using the technology, which has existed for some time. It's just we haven't really wholesale adopted it, as Andre said.
Thank you very much. I'm now going to see if we can broadcast over to one of our attendees, Carol Searle from TechCell Group. Let me see if this works. Carol, can you hear us?
Hello? Yes?
We can hear you. Please ask your question.
I think I had a phone bump on another phone coming in. I didn't have a question, if that was you. So I'm so sorry about that. Or did someone want to ask me a question? Hello?
No problem. Right, so what we're going to do now is I'm going to hand over to Sean Edwards, who's going to give a few concluding remarks, and then we're going to go into a wider Q&A with our panelists.
Thank you, Deepesh, and thank you for everybody who's rung in, either via Zoom or YouTube. I know it's a very worrying time for all of you. We're more worried about, I'm sure, our families than we are about our business. But one thing we do know is that this won't last forever. All of us will get over this physically. The questions, though, I think are much more longer lasting in relation to the impact of our business. Now, its purpose has always been to provide practical help. The area that is particularly under scrutiny is fintech. We are all looking to technology as a savior, and we've had to adopt very quickly, as Ash was saying, over the last few days, some very improvised positions around e-signatures. Andre has mentioned the work that prior to this pandemic ITFA was carrying out. That will now accelerate. So around distribution, where we think that we can use some of that technology to better focus state aid. It's just a little bit like quantitative easing for supply chains, because there is no doubt that when money at this scale is pumped out into the whole economy, there are moral hazard issues, there are issues of efficiency. We think that some of our fintechs can make that better. On the much more day-to-day and much more prosaic issues around digital documents and signing, Andre has mentioned the digital negotiable instruments initiative. We are also working on a paper around e-signatures to provide practical help. Must stress that you will need to look at this both in relation to the jurisdiction that you're in and to the jurisdiction of your counterparty, but we hope that will be some help. We have a lot of questions, so let's go back to them and try and answer them with the great panelists that we have. Deepesh.
Thank you very much. I'm sorry, I cut you off a little bit there. Okay, so I'm going to ask, I'm going to go to Andre and a question from Christian Goet. What is the most advanced fintech in AI document analysis? So Andre, over to you.
So basically, on the as part of the 23 fintechs we have two that are providing financial institutions with trade document checking solutions based on machine learning that enable to digitize paper documents, but most importantly, they enable to perform the checking of documents, a kind of automated pre-analysis that is assisting the doc checkers with machine-based results. And of course, the doc checker remains in control of accepting those discrepancies being proposed or not, or identifying additional discrepancies. Those technologies are based on machine learning. That means the machine continuously learns on how to interpret the data that is basically captured in those trade documents. The two ones we have is TradeStream and very easy. So TradeStream has been quite active through ITFA, working with us through various events. And as you may have seen recently, they signed up various Nordic players as part of a major pilot, which is now moving into production. So quite good testimonials, which is what we are after at this stage within the FinTech committee, demonstrating how banks are and corporates and funders, depending on the FinTechs we're talking about, are basically implementing those solutions. So you can reach out to those Uzer Bawani or Sam Segal on the TradeStream side, and additional contacts for other fintechs that you can find in the fintech guide we published last September, and which Deepesh through the TFG Hub will publish following this webinar. Again, I would want to highlight that whether it's for digital signatures, for automated distribution, we talked about allocating public funds to corporate SMEs, receivables, payables, all those technologies exist. Jaco was mentioning Bolero is getting more requests around the e-bills of lading. On the stock side, those technologies exist. We're not here to suggest we need to invent additional ones. It's all about increasing adoption, and I think now the banks have even more business, a stronger business case to go and start considering those. Same logic as for working from home, as I said earlier.
Thank you very much, Andre. I've now got a question that was actually emailed in by Ken Jensen from EKF, the Denmark ECA. What's the outlook and impact on COVID-19 for world trade in terms of increasing demand for issuing letters of credit or guarantees backed by national states? I'm going to get Joe to answer this. So Joe, let's get you up on the screen.
Hi, Deepesh.
Hey.
Can you? Yeah, perfect. All right. Thanks for that question. That's a very interesting one because I think there's 2 points to it. So using particularly sort of like ECA guarantees certainly come with several advantages. On the one hand, they certainly come with the advantage of mitigating credit risk for commercial banks. And that's really how ECAs really see their roles nowadays, as being the sort of like the last sure that no valuable export or no valuable transaction fails for lack of credit appetite. So they've always been a very helpful tool for commercial banks to actually say, yes, there is a valuable client with a valuable business proposition, but just something that doesn't fit within the institution's credit appetite. Can we get some cover for that? So great from a credit perspective. I think secondly, particularly in the times that we're experiencing now, where again, banks have to monitor very carefully the massive client impact that we're probably going to be facing here, and have to monitor very carefully there to make sure that they can service all clients at once. ECAs also come with the added advantage that under Basel III framework, they normally account for a zero risk rating. So they're very accretive to a bank's balance sheet in that regard. So if, for example, you have a transaction which is 85% insured by UK Export Finance, then basically there is 85% less balance sheet usage for that particular transaction. So you get the credit benefit and you get a balance sheet benefit, which of course makes it then a lot easier for the bank to actually issue, for example, a letter of credit, or issue a guarantee, or even provide a short-term trade finance related loan. And that in turn, of course, might help some customers that otherwise would have not necessarily gotten the same support. So I think in this time and age, it's definitely very, very important that the ECAs watch out for clients, watch out for where there might be a need. Certainly banks work very closely with the national ECAs And I think that that can be certainly a very helpful extra tool in the kitty next to other central bank or government intervention.
Thank you very much, Joe. We have one more question from Christian Grepp again, and I'm going to ask David Necker to answer this. So in France, banks reschedule short and medium-term loans to companies, and the state guarantees 90% of more than 300 billion, in the case of BPI France, in bank loans, which can amount to up to 25% of the company's turnover. David, what do you think about this? I'm just going to... You're on.
Okay, fine. Christian, this is part of, this is an interesting question because it's part of a huge movement that's going on within the public sector. I mentioned briefly earlier on that the European Commission have asked for a response to something that they have, a consultation they've just issued, which is due in today, about the credit insurance market. And this is typically what we saw in 2009 as well. Only in this case, the actions are faster, they're delivered directly to the banking sector. And BPI is the sort of successor of what used to be called COFAS. And it's impressive that they were able to swing this into action. I think that for trade credit, which is more where I feel your question is sort of is relevant to our communities here, is there will be people saying, well, if my credit insurer is not able to provide cover because the limits aren't enough, or they're not able to actually grant a limit, what should I do? And I think it's reassuring that the Commission has already started to kick that off. And I believe there are already, I think in Denmark and Germany, other places, there are initiatives which are going to support businesses. And it's not so much the banks themselves. I think it's also the SMEs that themselves are, who depend upon trade credit insurance, receivables insurance, to have some degree of certainty. But it is not a simple matter. We had this in the UK in 2009, and it's because there's a complex set of relationships. They can't just deliver a guarantee just like that. It's a little easier when you can go to a bank and the banking market is readily available. But watch this space, because I think they will have to do and learn the lessons of 2009, find quick and effective solutions to provide backup through probably reinsuring private sector credit insurers to give maintain cover or give new cover to businesses trading globally in these very uncertain times.
Thank you very much, David. So on that note, we're going to wrap up, and just to let you know that these recordings will also be published on both ITFA and Trade Finance Global's website. Huge thank you to Sean Edwards and the ITFA team for helping us, and also the TFG team for making this incredible webinar possible. And extended thank you to our great panelists, David Necker, Joe Wissing, Andrew Casterman, and Ash McDermott. We will see you in our next webinar, and we will also be answering our questions on the website. Thank you. Goodbye.
Thanks.